It is possible to get rich by investing in cryptocurrency, and it is also very possible that you lose all of your money. Multiple factors prove that cryptocurrency is not always a safe investment, but at the same time, some signs are emerging that crypto is also here to stay. Over the years, there have been a mix of emotions about cryptocurrencies. There have been excitements, and vice versa, there have been fears, passion, and skepticism. So it's time to justify these emotions properly. Why are some excited about crypto, and why are some scared about it? Many are scared about cryptocurrencies, even those that have decided to take the risk to invest in it. It is a legitimate feeling given that recent spike in crypto trading and the government struggles to keep up with the unrelenting regulation. The safety of crypto investments will continue to be a more pressing issue in the coming years. A recent report from Allied Market Research projects claim that this concern could linger until 2030. The more popular cryptocurrencies become, the less trustworthy and efficient they are, according to a central banking organization. Quote, cryptocurrencies are not scalable and are more likely to suffer a breakdown in trust as they grow. According to the annual report from the Bank of International Settlements, which is the umbrella organization for the world of central banks. The BIS is warning the world's central banks to think hard about the potential risk before issuing cryptocurrencies of their own. The report added that effective regulation of digital coins needs to be global, targeting both financial institutions as well as companies offering crypto-related services. In a world plagued with constant crashes and heightened regulatory activities, it is just normal for people to fear. How can people trust a system that is subject to skepticism and doubts from the governments and other top officials? Of course, over the years, cryptocurrencies have yielded head-spinning returns for investors, but all the fears are still evident. A week ago, IMF Managing Director Kristalina talked about crypto regulations on the sidelines of G20 meetings for finance ministers and central bank governors. Commenting on crypto oversight, she said, "There has to be more regulation." Her statement followed a roundtable discussion where she agreed with India's finance minister that besides debt restructuring, regulating cryptocurrencies is a major need. Kristalina explained that the IMF, the Financial Stability Board, and the Bank for International Settlements are entrusted with the responsibility of regulating cryptocurrencies that are not issued by governments or central banks. She hammered the need to differentiate between central-backed digital currencies that are backed by the state and stablecoins and crypto assets that are privately issued. There has to be a strong push for regulation, the IMF chief noted, emphasizing that if regulation fails, if you are slow to do it, then we should not take off the table of banning those assets because they may create financial stability risk. The IMF Executive Board provided directives to help countries develop effective crypto policies, while most of them conceded that strict bans are not the first best option, but that targeted restrictions could apply. A few opined that outright scams should not be ruled out. In addition, the board suggested crypto assets should not be granted official currency or legal tender status to safeguard monetary sovereignty and stability. Kristalina also shared the same thoughts. Crypto assets are nothing. They cannot be accepted as legal tender, she said. Furthermore, the United States Treasury Secretary Janet Yellen emphasized the importance of implementing a strong regulatory framework for cryptocurrencies during a meeting. Yellen said that it was critical to put in place a strong regulatory framework. She also noted that the United States is not suggesting an outright banning of crypto activities. Yellen's remarks came after the IMF's chief's claims about crypto. While it appears that crypto was treading on still water since the beginning of the year, a storm-like situation has spurred, instigating more fears in investors. According to reports, the well-known crypto bank Silvergate Capital reported in a regulatory filing that it would need to delay filing its annual report with the SEC. This announcement came after Silvergate reported earlier this year that it is seeing close to 70% of its deposits in the bank in the fourth quarter of 2022. This led to the bank to sell a huge amount of bonds while they traded at a loss, wiping out shareholder equity. As a result, cryptocurrencies plummeted. Bitcoin shook off some of its most recent gains, but not as badly as Silvergate's stock, which lost over half of its value. The crypto declines hit almost all the major cryptocurrencies in the market. Bitcoin is down 4.5%, dipping from $23,500 to a 2-week low of $22,259, before climbing to around $22,390. The leading cryptocurrency last traded at these levels on February 15th, with the latest price action wiping out $20 billion of Bitcoin's market capitalization. Ethereum tumbled 4.6%. Other major altcoins had their fair share of the decline. Cardano, Polygon, Solana, Polkadot, and Avalanche suffered losses within the 4 to 5% range. Cryptocurrencies similar to Dogecoin and Litecoin were hit harder, losing 6.2 and 8.5% in value respectively. So the market capitalization of all cryptocurrencies shed around $48 billion overnight, and it currently stands at $1.077 trillion. The answer of how safe crypto is, at least for now, remains complicated. Cryptocurrency does come with some security risks that investors should know before making a first trade, as crypto is extremely volatile, and that is not strange to the ears anymore. Also, this relatively new and partly unregulated financial ecosystem comes with its share of scammers looking for ignorant newbies as prey. As a result, apart from keeping track of how crypto is performing, one has to have an understanding of keeping their wallet safe and secure. One of the ways to keep one's digital assets secure is to comprehend how wallets and exchanges in the first place work. People often fall victim to vicious emails, links, and messages received to make quick profits. Being informed and not falling for such activities is important. Individuals can take extra measures to secure their funds, like securing the private keys by backing up their wallets. So there is no need to be afraid of what can be avoided. Although cryptocurrency is known and talked about globally, people still have doubts and preconceived notions about how the crypto market and digital currencies work. There are more than 10,000 cryptocurrencies in the market right now, and it is difficult for investors to understand which one to invest in. Plus, there isn't any significant information available on these companies and their owners or pioneers. People who are not aware of the background of certain crypto companies are quite vulnerable to mistrust. And just like the stock market, crypto is a volatile industry and the trends keep changing rapidly. Experienced investors have experienced the highs and the lows in the market and understand that this market is about the long haul. One can make short-term gains, but to build a solid portfolio, one must keep on holding on for dear life, or HODL for short. This issue of volatility is quite traumatic, and this creates fear in prospective investors. Being one of the most volatile investments in the world, the prices might just see dramatic pumps followed up by tragic dumps, hence dampening investors' trust. However, crypto investments are worth taking the risk as their volatile nature might get attractive trading in return. In addition, blockchain technology is doing just fine. This technology and the crypto world have a massive potential to change investment trends and eventually take over the existing financial activities for better access to financial freedom for investors. With the growth of blockchain technology, people will take time to get out of their fear of crypto because the mass adoption will dominate the crypto market. Despite the risk, cryptocurrency and the blockchain industry are growing much stronger. As financial infrastructure is being built, investors are increasingly able to access institutional-grade custody services. Professional and individual investors are gradually receiving the tools they need to manage and secure their crypto assets. Crypto futures markets are being established, and many companies are gaining direct exposure to the crypto industry. Other factors still affect the riskiness of cryptocurrencies. The mounting pace of adoption is an indication of a maturing industry. Many cryptocurrencies such as Bitcoin, Ethereum, and Cardano are launched with lofty goals, which may be achieved over the long term. While the success of a crypto industry has slim chance of assurance, early investors in the crypto project that attains its goals can be greatly rewarded over the long term. For a crypto project, achieving widespread adoption is required to be considered a long-term success. If you're confident that crypto usage will become increasingly widespread over time, then it makes sense for you to buy some crypto directly as part of a diversified portfolio. And here's a little bit of additional advice for every cryptocurrency that you decide to invest in. Be sure to understand whether the cryptocurrency will stand the test of time. Do your research well. Yes, everyone may be scared of cryptocurrencies, but as a well-informed investor, those fears are unnecessary. And that's going to be it for today's video. Make sure you click on the subscribe and notification buttons.